Then Sunil Subramaniam, MD and CEO at Sundaram Mutual Fund, joining it on the show right now. Sunil, hi, good morning. I'm tempted to talk about the markets, but given that it's a very quiet start, let me talk about Burger King because that's all the chatter on D Street today as the IPO opens. And you as well have been one of the anchor investors at Sundaram Mutual. Tell us what excites you about the IPO. What is it that you like about the Burger King story?
Sorry, I can't comment on the specific stock, as you know, regulatorily. But basically in the sector itself, right, where this company belongs, I think that it's ripe for a bounce back. You know, post-COVID, that was the sector which got most affected, the entertainment, food industry. And we expect that there's going to be a sharp revival in that segment. The GDP data coming in have shown that Diwali has proved to be a booster. And I think that from that perspective, I think this sector looks very attractive, and that's why we felt that we could anchor a company in that sector. That beyond that, I can't speak specifics on the company.
Fair point. I completely understand that. QSR really has seen a great recovery post-COVID and faster than what anyone anticipated, surely. And that's been the case with the broader markets as well, Sunil. Finally playing catch-up right now. Do you think for a mutual fund investor, it makes sense to perhaps increase that exposure to the mid and small cap schemes just that bit?
Absolutely, because what we are now seeing is a broader rally, right? And the broader market, see, what has been the main driver behind the market has been the FII flows, about what, 1.6 lakh crores since April to now. Mutual funds have actually been sellers in this period. They've sold almost 60,000 crores. Part of it was because there's net redemptions in the industry from investors, but part of it was an active call because the polarization that took place in the FIIs buying good quality stocks and good sectors, which is safety in the post-COVID phenomenon, now is changing, right? So the mutual funds actually were waiting with their cash on hand because they were not either regulatorily, because 10% is a stock limit, buying into those stocks, and they were selling when the FIIs were buying. The second aspect is that they were waiting for the V-shaped recovery because you need cash on hand to buy, and you're beginning to see that. And in fact, if you look at the data post-COVID recovery, let's say 31st March to now, it's a small cap index which has gone up 60%. The mid cap is about up 50%, and this large caps are actually trailing despite getting 1.5 lakh crores of liquidity dedicated to the large cap sector. So you can imagine that mutual funds today have that cash which they are naturally going to deploy into a broader market. That being said, small caps, mid caps, and also I would point out to the industrial, cyclicals, domestic economy sensitive stocks within the large cap space. Because of the 15 Nifty stocks, what 15 stocks have accounted for most of the rise. So there's still 35 stocks which are more domestically. So I would say, while mid cap and small cap you have pointed out is a good point, I would say actual thought processes shift focus to domestic economy sensitives, because that's where the action is going to be. And naturally, mid and small caps are heavily oriented to domestic economy.
Sunil, the domestic, tonality or the domestic sentiment still seems to be skewed a little towards selling or redemption. Why is that? Is it just taking money off the table? Is there any cautiousness you're reading into this? What are the trends as you see it?
So if you look at it, actually, we've done some analysis on this at our end. So what happened is that post-demonetization, right, November 16, is when the mutual fund industry saw a massive amount of inflows stepping up, mostly from new investors, first time experiencing. What supported this was the Jan Dhan Yojana, where a lot of unorganized sector money, black money, so to speak, moved into the organized banking sector, and hence a portion of that came to mutual funds. Why I'm saying this is the industry saw a phenomenal amount of first time into equity investors come in the year 2016, calendar 2017. Now, those who came in earlier saw a phenomenal rise because the markets reached a peak in December 17. They also saw a phenomenal rise in their valuations, were very happy. But those who came in, let's say, second half of December, June to December in 2017, saw a short rise. And then from January 18, as you know, the broader market has seen a sharp correction. The FII's buying has kept a few large caps steady, but by and large, if you see diversified funds, mid-cap funds, small-cap funds, have seen a steady erosion in their thing. In Jan-Feb this year, right? You started seeing a bounce back because economy was showing signs of coming out of the ILFS crisis, the negative inflation and all of that when COVID hit. So, and the March hit wiped off all the gains of all these people who came in 2016-17. So they were sitting on an unhappy experience in March and first time, so they were like a little bit, what is this? Market showed us great highs and then great losses. And then when the bounce back occurred from April to October, right? These people started getting their money back to their capital that they had put in. So those who saw an erosion in their NAVs below 10 saw it come back. And normal human emotion says that, look, I have now escaped. I saw a big jump earlier, a big fall. I've got back my capital. Put it in a Hindi term, my baal bach gaya. And so there's been a relief profit booking because they didn't understand this whole volatility of the market. So that money has moved into liquid funds, into bank savings accounts, deposits, wherever, and is lying there. So it's essentially that pocket of money which has driven the redemption low. New investors continue to come in. You see industry folios are rising. New fund offerings have raised almost 8,000 crores over the last 3-4 months. So there is fresh people who are looking at the markets entering, older investors, those who stayed invested for 3 years, 5 years, despite SIP returns not being great, have stayed invested. So clearly the 2016-17 inflow pocket has been the main driver of the redemptions in these 6 months because it's a natural part of the learning curve. And I expect that as now it becomes a broader market recovery and they see that they should have hung on there, they'll start coming back. So I'm not unduly worried. The other thing which supports what I'm saying is the fact that SIPs have only seen a 3 to 5% correction from the peak of 8,500 towards 7,800, right? So it's not been a massive drop in the SIP. So long-term investors are continuing to stay invested. I don't see any panic situation there. It's a phenomenon of new investors first time experiencing the volatility of the market.
Fair enough. Now, given that, volatility, is likely to kind of stay in the sense that while we've had momentum building up, on the other hand, plenty of good news that could be around the corner, but any news that's sort of, out of the ordinary when it comes to the vaccine, any disruptions in those trials, is leading to some amount of a knee-jerk reaction as well. So what would you advise as an appropriate strategy then, given that, as you said, investors who have not necessarily been experienced with this kind of market may continue to be a little jittery?
So I think the best and the smartest way to do that is to stagger your investments. There are 3 ways to stagger it. One is to simply do SIPs. Second is to do STPs, where you park it in liquid and you do. The third is to do smart staggering, which is you take a starting level of whatever you enter, and whenever you see a volatility of, say, 2% of the market, you put in more money. So I think somewhere, if you stagger your flows over the next 12 months, right, I think it's an ideal time because the Indian economy is now coming out of this, the V-shaped recovery is clearly beginning to be visible. We're actually looking at 21-22 being a double-digit GDP YOY growth. The reason it's double-digit is because the base effect was very bad, right? But still, it's going to post double-digit, and the markets will feed off that sentiment. So I think staggering their investment, because bear it in mind, there is going to be volatility for another 6 to 12 months at least, because vaccine coming, going, second wave coming and going, how Biden acts on the trade, on the world front. There are uncertainties around. But the long-term footprint of the Indian economy is robust, and it's a matter of when and not if. So with that perspective in mind, right, I'm suggesting that you stagger your investment. Don't put it into lump sum. And I would say that at this point in time, from a large cap, mid cap, small cap perspective, I would suggest a 50-30-20 split. 50% into large caps, 30% into mid caps, 20% into small caps. Most of it in a staggered. If you want to do some lump sum, still stick to the large cap space, because in a diversified large cap fund, you will still get the exposure to the Indian economy, because fund managers, I see them shifting their portfolio from a safety orientation to a greater risk orientation. So that's my suggestion. Stick to a diversified large, mid, small, and stick to a staggered investment process.
Sunil, hi there. Good morning. Apart from Burger King, we're also looking at the Airbnb IPO, $2.6 billion, valuing the company at about $34.8 billion. You know, the company was initially hit very hard by COVID, but they've bounced back quite quickly. And, you know, if we even were to look at examples like Indian hotels, they're now expanding into a more deeper inroads into Eastern India. And a lot of these travel companies have seen quite a meaningful recovery after being badly bruised. Is there merit in this story?
There is merit for two reasons. The very deep correction now bringing value into play and the pent-up demand. End of the day, there is a travel bug in people. There's an entertainment bug in people. People can't get cooped up in their homes. So you will see a phenomenal sudden jump up and then it will stabilize. So the way I see it is like a V with a slight flattening growth. So I think initial bounce back rally will be very strong. Those numbers will surprise on the upside. And as you know, the market deals with consensus versus actuals. So I expect the actuals to actually beat the consensus because people in their predictions are still carrying a conservative bent of mind. Right? Nobody goes and says, oh, there will be a 40% jump. But actual reality, 40% jumps happen. So I think this gap between consensus and reality is going to actually drive this sector up. And I think the early bird will get a lot of the worm. So I think the earlier you move in and get these opportunities, because in about, say, 6 months' time, things will stabilize. You won't see those opportunities again. So it's a great GARP value. What do I say? Growth at a reasonable price.
Okay, fair enough. That's the entire travel cluster. But what about when it comes to the capital goods space, infrastructure? You have seen incremental recovery kick in. A lot of those supply chain issues have been smoothened out now. And, you know, a lot of capacities are now operating at nearly as much, or if not better than pre-COVID levels. So how are you looking at playing the entire infrastructure and capital goods sector?
I would say yes, if you have a clear 3 to 5 year perspective, it's good because it's not a 1 to 2 year bet yet. You've got to give it time. See, when everybody is getting very happy with touching a pre-COVID level, you're forgetting that pre-COVID level was actually a downturn starting from December 2017. Economy was actually a 3 to 4% GDP growth before COVID. So it's not a great celebration to say, oh, I've reached pre-COVID. It's a relief to reach pre-COVID, but we need to reach December 2017 levels. Right? Capacity utilization pre-COVID was at about 72%. Pre the crisis was at 72. Through the crisis, it came down to mid-60s and COVID hurt it further. So this going back to 72 is still not good enough for the private sector because it's going back to pre-COVID levels. But every private sector player still has adequate capacity to cater to the next 12 to 18 months of demand. So domestic CAPEX as a driver for infrastructure and capital goods companies will take a little bit of time. You've got to be patient there. But what can give it a bit kickstart earlier are two other things. One is the coming budget on what the government plans to do on infrastructure. Because the rating agencies, I suspect, are going to be with a kind eye to countries all over the globe in terms of the fisc. So I think a little bit of extra fiscal deficit is not going to be frowned upon, won't lead to too much damage to our rating. So if the government is going to use that money right, because the rating agencies look at the quality of your expenditure apart from the quantity, which is a fiscal deficit. So if that quality is diverted towards the reform-oriented infrastructure sector, the rating will also will get protected, but you will get a boost to the capital goods sector. So I'd like to wait for the budget to take a call on the government-driven CAPEX, government and PSU-driven CAPEX. The other factor, the X factor, which can actually tilt the scales is FDI. As you know, the tax rates for new manufacturing companies have brought down to 17%, which is among the best in the world. And with the supply of land and labor and the reforms happening on that front, I think the government is opening the door to FDI in defense, in railways, in a lot of places. They opened up the public sector to private sector, where also foreign participation can come in. So if FDI in the manufacturing sector shows a sharp spike in the coming months, then I would actually fast track my infra and capital goods revival. So just to summarize, three clear things. Domestic CAPEX will take some time. Government CAPEX, wait for the budget to decide. But FDI, because the government has been working steadily, and our ease of doing business improvement is also contributing, is seeing that a great jump in FDI. The government is announcing the PLI schemes, the production linked incentive to get manufacturing in. I think that if it shows a faster than expected growth rate in terms of FDI announcements, you can expect that factories need to be set up, cement, steel, building materials, all of these are going to be in demand. So 3 key separate factors to track, but I would say that still a 12 to 18 month window where I would actually put discretionary consumption, auto and banking and financial services as early wealth creators. And the second stage will be your infrastructure, capital goods and the related segments.
Okay, fair enough. And what about when it comes to autos? How have you looked at the kind of auto sales numbers that have trickled in for the month of November? After seeing that festive spurt, we have seen recovery that has managed to sustain. Do you like the deep cyclical plays here? Are you very specific when it comes to two-wheelers, four-wheelers, betting on the rural theme? How are you looking at autos?
So for me, auto in the shorter period is essentially a rural-driven play. So rural-driven play would mean tractors, two-wheelers, and entry-level cars. So I think these three will be the first leg of the auto rally. The second leg of the rally will be the high-end auto segment in terms of cars and high-end bikes, because that's when we think that coming the summer and all of that is when we see that sharply picking up, because you have also the March end depreciation and all of those things giving a boost from a corporate lease back purchases. The third segment, which may take a little bit more time, is the commercial vehicle, light commercial, heavy commercial, everywhere, because the GST introduction has led to a huge overcapacity and it's gone into a cyclical downturn. So I think that unless the government does in the budget some very strong things like scrapping old vehicles, something on the multi-axle vehicles front, something else, unless the government does something specific in the budget, we think that the commercial vehicle segment will be the last to recover. So our portfolio allocation would accordingly be positioned accordingly in the auto space. But overall, I think the auto space, because the last year was very bad, YOY, whether it's sales, whether it's profits, whether it's stock prices, everything is going to look good because of a bad last couple of years.
Sunil, always a pleasure having you on board. Thanks much for joining in and sharing with us your outlook on the markets.